Hello students and welcome to this explanation on PPE and investment property and going between the two in transfers of intention. So this question is called Metro Limited. We can read together. It states that you are the accounting clerk of a large firm that is called Metro Limited and they own a number of assets. The company has a 28 February year end. The financial director asked you to address, it should read, all the questions relating to the assets below. So in number one, we have matters that relate to land, and they tell you that they own 7 properties throughout the country, which consists of land. So there is property Parel, I think that's how you say it, property Kimberley, Potchefstroom, Pretoria, Johannesburg, Cape Town, and also Vereniging. They've given you a cost price, they've given you a fair value at the beginning of the year and at the end of the year, and they've also told you the classification as to whether it is investment property or PPE. They've also given you a summary of the policy. It says that land is not depreciated. Land classified as PPE is carried on the revaluation model. Revaluations are performed at year end through the elimination of accumulated depreciation. So, of course, here we will have no accumulated depreciation to eliminate if the land is not depreciated. Land classified as investment property is carried on the fair value model. Fair value adjustments are performed yearly at the end of the financial year. On 1 April 2014, it was decided that property Johannesburg will henceforth be kept for the purpose of capital appreciation. And on this date, the property had a fair value of 1.2 million rand. So here you can see that the intention changed. It used to be PPE, now it's becoming investment property. We need to account for that change. In matters number 2, we have transactions to talk about relating to buildings. So Metro owns 4 different buildings, as you can see, building 1, 2, 3, and 4. They've given you a cost price and an accumulated depreciation, the classification of it, and the fair value at the beginning of the year, and 1 fair value at your end as well. Then they say buildings classified as PPE are depreciated over 25 years on a straight line basis. No residual values apply. Buildings are carried on the revaluation model through the application of the elimination method. So again, we need to take out accumulated depreciation. Revaluations occur at the beginning of the year. Buildings classified as investment property are carried on the fair value model. On 1 May 2014, Building 1 was reclassified as PPE, so investment property became PPE as it was reoccupied by staff members. On this date, it had a net replacement value of 1,602,000, and the remaining useful life of the asset was 186 months. On 30 June 2014, Building 3 was reclassified as investment property and rented out to a third party under a monthly lease for 18,000 Rand a month. The net replacement value of Building 3 on 30 June was 2.4 million. In matter number 3, there is a vehicle. They say on 31st January 2015, a hailstorm caused damage to a vehicle. Information relating to the vehicle is demonstrated in the table below. The vehicles are carried on the cost model and depreciated over 5 years. Great. Then in note number 1, they ask us we need to do the journal entries that relate to property Johannesburg. On 28 February 2015, no narrations are required. Then in note number 2, or require number 2, we need to do the journal entries for building number 1 as at 28 February 2015. In required number 3, we need to do the general journal entries recording building 03 as at 28 February. Number 4, we need to calculate the impairment loss. Note number 5, we need to disclose the investment property note. And then note number 6, we need to do a PPE note as at 28 February, but the note should only contain buildings. Right, let's start. I'm just going to open the Excel spreadsheet. As you can see, I already have a number of entries here. I have recorded this video once before, only about 30 minutes in to realize that the sound wasn't working. So that was quite devastating, but at least now we have a bit of a skeleton. So we need to do some general journal entries in note number 1 that relate to property Johannesburg. And the first thing we need to do is, this is a situation where it is becoming investment property. So first we need to revalue the land on the date that it is or that the intention is changed. So you will see on the question, Property Johannesburg has a cost price which represents the fair value at the beginning of the year. So at the beginning of the year, the fair value was the cost price 1.1 million. Then you will notice that on the date that the intention changes, which is the 1st of April, it is worth 1.2 million. So here we need to measure a revaluation surplus because the PPE value is increasing. There is no accumulated depreciation to eliminate, so we will simply say the difference between the 1.2 million and the 1.1 million at the beginning of the year gives us 100,000 Rand. Then we need to transfer the land to investment property at the fair value on the date of change in intention, which was 1.2 million. And by year end, a fair value adjustment income needs to be recognized because you will see by year end, this building is worth 1.3 million. So we need to measure the difference between 1.2 and 1.3 million as a fair value adjustment to what is now investment property. Right, then we can move on to required number 2. In required number 2, we are asked to do some calculations that relate to building number 1, which was investment property and then became PPE. So if we look at building 1, the fair value at the beginning of the year was 1.6 million. In order to transfer investment property, we need to first revalue it, and I see the value on the date of change of intention is 1.6 million and 2,000 Rand. So that is then a difference from the 1.6 million at the beginning of the year. So it has grown. Oh, come on. So it has grown by a total of 2,000 Rand. We need to transfer it to PPE because building number 1 is now reoccupied by the staff. So it becomes PPE and we need to transfer it at the fair value on the date of change of intention, which is 1602,000. And then at the end of the year, we of course need to now recognize some depreciation because this is now a PPE item. And here we're going to take the 1602,000 and we're going to divide it by the remaining months, which is 186. They've told you in the question that the remaining months is 186 months. Then we need to count how many months has this asset been in use. So it has been in change, the change in intention took place on the 1st of May. So it's been in use between the 1st of May as PPE up till 28 February. So it is May, June, July, August, September, October, November, December, January and February. So I count 10 months. I'm going to do the calculation then, taking the price that it was transferred at, dividing it by the remaining life, and then times 10 months. So that gives you a 86,129 and 3 cents. 3 cents just for a little bit of precision. Right, in required number 3, we need to do the journal entries relating to building 03. So in building 03, what happened is on 30 June, it was reclassified to investment property. So it used to be PPE and now it is investment property. So we have to go and measure a revaluation surplus, then eliminate all the accumulated depreciation, and then we can transfer it to investment property. Right, so the cost price of building 03 was 2170,000. The accumulated depreciation at the beginning of the year was 27125, and that gives us a carry value of 1242875. The fair value of building 3 at the beginning of the year was 2.2 million. So I'm doing the revaluation at the beginning of the year. And so the revaluation surplus at this point is then the difference between the fair value and the carry value on the 1st of March. So that gives us 57,125. The first step that we will do is we need to eliminate the accumulated depreciation. So we are going to say debit the accumulated depreciation on building 03. And we're going to play it off against the asset, which is building 03, which is currently still PPE. And the accumulated depreciation at the beginning of the year is given to us, 27,125. Righty, then we need to recognize the surplus. It is going upwards, so it is the fair value was more than the carry value, so we're increasing the value of the asset. So we will take a debit to building 03, and we will credit the revaluation surplus, which is other comprehensive income. Right, then we have a situation where the intention is changed, and that is on the 30th of June 2014. So now this PPE should become investment property. So the first thing we will do is we need to recognize some depreciation on this asset between March and June. And that would be accumulated depreciation, and that is then on building 03. Again, we need to go and find the calculation for depreciation and go and see, but how many months remained, because here in this question they don't tell you the remaining months. So a calculation needs to be done. So we want to know what is the total life. The total life, we are told by the policy, it is 25 years for the buildings. So the total life is 25 years times 12 months, which is 300 months. All right, so how many of the lifetime was actually used up at the beginning of the year? So at the beginning of the year, we had a accumulated depreciation of 27,125. So we need to go and do a calc and see. All right, so what is the depreciation for 1 year? And that would be, of course, then the cost price at that point divided by 25 years. So it is 86,800 for 1 year. What was the accumulated depreciation at the beginning of the year? It was 27125. So they haven't even used this for a whole year, because if we take the 27,125 and we divide it by 86, it was used for 0.3 to 5% of the year. All right, so it was not depreciated for a full year. Now we need to go and figure out the months. So in months, we are going to take this percentage and times it, of course, by 12. So it was then depreciated for 3.75 months. So at the beginning of the year, we used up 3.75 months. So the remaining life at the beginning of the year was 300 months minus 3.75 months. So it was 296.25 months. All right. So now we know that since then we've had a number of months go by, which is March, April, May, and June, which is 4 months. Just want to put this calculation in a block. Therefore, we're going to say for depreciation, we need to take the 2.2 million rand fair value, which we obtained or which we increased it to at the beginning of the year. At the beginning of the year, how many months remained for it? 296.25 months. And then how many months between March and June? A total of 4. So the depreciation that we need to recognize is 29,704 rand and some 64 odd cents. After we've done that, we need to start with the reclassification to investment property. So I need to close off this accumulated depreciation against the asset, because this is now the only accumulated depreciation which exists. The 27,125 we have already written back in this entry when we did a revaluation at the beginning of the year. So we're going to play it off against the building 03, which is PPE, and we're going to write it back. The accumulated depreciation is this total. Right, we need to measure a revaluation surplus. So we're going to say, what is the carry value of the asset? So again, we need to do a calc. We have a cost. We have accumulated depreciation. The cost of the asset currently is 2.2 million, which was the previous revaluation that we did, the fair value thereof. And the accumulated depreciation we just calculated, which should be the 29,704. So the carry value on the date that the intention is changed is 2170295. We need to measure this up against the fair value on 30 June. And the fair value on 30 June is given as 2.4 million. So what is then the adjustment or the revaluation surplus? The revaluation surplus is the difference between the fair value and the current carry value, and that is 229,704 and some 60 cents. Just want to see. So we're going to recognize that by taking buildings and crediting revaluation surplus by the difference. Now we can transfer it to investment property, of course at the latest fair value. So we're going to increase investment property. We're going to decrease buildings. 03 PPE. And the latest fair value was 2.4 million, I beg your pardon. Right, thereafter it is now investment property, and at the end of the year we can recognize some rental income, I believe. So on 28 February 2015, we can say bank or debtor, and we will increase the rental income. And now we need to count the months. So it is 18,000 Rand per month. And now we've rented it out between the 30th of June and the 28th of February. So they will pay then, if the contract is effective on 30 June, the tenants need to pay for July, August, September, October, November, December, January, and February. So they have to pay for 8 months. The rental income is then 18,000 times 8 months, which gives us 144,000. They could have also given us a fair value at year end. I believe that we were not given a fair value at year end for building 3. But if they've given us a fair value for building 3, we could have also done a fair value adjustment. However, they only give us a fair value on 30 June. So there should probably then be no fair value adjustment there. Right, so that is then required number 3. Let's look at required number 4. In required number 4, they ask us to calculate the impairment loss of the vehicle. Right, so we need to know what the carry value is on this accident. I believe takes place on 31st January 2015. So we need to go and see what is the carry value. So the cost of the vehicle is given to us as 425,000. Then we have some accumulated depreciation, and that is on 1 March 2014, and that was given as a total of 108,000. So to get to the carry value, we still need to depreciate it between 1 March 2014 and 31st January 2015. So that should be, according to me, 11 months, because there's only February short to make it a year. So that's 11 months. So we need to do a calculation. 425,000 minus the residual value, because you were not explicitly told that this asset is investment property. So if they told you this vehicle was investment property, then you won't minus the residual, but they only say the vehicle is owned. So that should be PPE, divided by the useful life of 5 years, and then 11 months have passed. If I do that calculation, 425,000, I minus the residual value, I divide it by useful life of 5 years and depreciation for 11 months, I get 66,000. So the carry value on 31st January 2015 is then this cost minus the accumulated depreciation minus the additional depreciation for the current year. So the carry value of that asset was 251,000 on 31st January 2015. Right, we need to now go and measure an impairment loss. So it's the fair value less cost to sell versus the value in use. So what is the fair value less cost to sell? It is given to us as 180,000 rand in the block. And then the value in use is given to us as 210. So we know we should measure the carry value against the higher of fair value less cost to sell or value in use. And you will agree with me, this 210 here is higher, so I'm going to use that one. I'm going to say the impairment loss is then the current carry value and I need to play it off against the value in use. And that gives us an impairment loss of 41,000 rand. So the impairment loss for the vehicle on 31st January, 41,000 rand. That was quite easy. Moving on to required number 5, they ask us to do an investment property note. February 28th, 2015. we need to go and determine which assets were investment property. So I'm just going to go through my question and check. So at the beginning of the year, investment property was property Parel, property Kimberley, and also property Cape Town, property Vereniging, and then property Johannesburg became investment property. Then we had building 01, which was investment property, and building 3, which became investment property. So I'm just going to type all these names in order to have a decent investment property note. So we're going to have property Parel, property Kimberley, should be an E there. Then also property Cape Town, we should also have property Vereniging, move it slightly. Then we also had the property Johannesburg, which became investment property. Then I remember we had a property, in terms of buildings, it was building 1 and it was building 3. And of course, we needed total. For the investment property note, we're going to start with an opening balance. And we're going to have some movements. In this instance, we had some fair value adjustments. And I believe it was income. And we had some transfers to PPE. And I believe we also had a transfer from PPE. And then we had a closing balance. Right. I'm going to start with the easy ones like property Parel. They've given you the opening balance, 2950,000. They've given you the closing balance, 2880,000. So I was wrong. In this instance, it went from a lot to lesser. So we needed here a fair value adjustment expense because it was worth less. And the expense, the fair value adjustment expense was then 70,000 Rand for the year. If we look at property Kimberley, also quite easy, 1125 triple, I beg your pardon, it was 1750,000 at the beginning. At the end of the year, it was 1825,000. So that was an increase. So that's a fair value adjustment income of 75,000 Rand. In terms of property Cape Town, at the beginning of the year, it was also worth 1750,000. At the end of the year, it was worth 1850,000. Again, this is a fair value adjustment income, and the difference which represents the income is 100,000 Rand. For property for Enigen, at the beginning it was worth 1,125,000. At the end of the year it was worth 1,175,000. Oh, come on. And again, it increased, so there should be a fair value adjustment income of 50,000 Rand. So with property Johannesburg, it was kept as PPE at the beginning of the year, so the opening balance was 0. But then we transferred it from PPE to investment property. And I believe the transfer was done on 1 April at a fair value of 1.2 million Rand. So transfers from PPE was then a 1.2 million Rand that we received. And did we have a fair value adjustment on this asset? We did. I remember a fair value adjustment of 100,000, which was the difference between the 1.2 million transfer and this 1.3 million Rand at the end of the year. So this is basically these two represent these two entries that we've done here. There's the transfer from PPE, there is the fair value adjustment income. At the end of the year, the closing balance should be 1.3 million Rand in accordance with the table. Right, then we had Building 01. And Building 01 was investment property at the beginning of the year, and it had a balance represented there of 1.6 million in the table. Then we did a fair value adjustment to it, and I remember it became PPE so there's a transfer to PPE at its fair value of 1,602,000. And I remember we had to do it fair value adjustment income of 2,000. So basically this is the entries that we've done here. There's the fair value adjustment income. There is the transfer. So we minus from investment property so that it can become PPE. At the end of the year, the balance was, of course, 0 because it's no longer investment property. It is now classified as PPE. In terms of Building 3, at the beginning of the year, Building 3 was classified as PPE. So the opening balance for it would have been 0 because it wasn't investment property at that point. But we did transfer it from PPE to investment property. So that is transfers from PPE, this side, for 2.4 million. And I remember we also had to recognize there. Oh yeah, there we couldn't recognize a fair value adjustment because they didn't tell us the fair value at year end. They only told us the fair value on 30 June. If you read this paragraph again. Right, so at the end of the year, it's going to be worth 2.4 million Rand still. At this point, I'm just getting to totals, so I'm just using my sum function. And there we go. This would be your investment property note on 28 February 2015. Quite interesting. Right, the last required part that we have to do is required number 6. And for required number 6, we have to do the property, plant and equipment note. And we should only represent the buildings. So it is property, plant and equipment as at 28 February 2015. Here we had several buildings. We had building 01, building 02, building 03, building 04, and we also of course need a total column. We're going to start with cost, accumulated depreciation, carry value. Then we're going to have some movements in the PPE. There we will have depreciation, revaluation, surplus, transfers to investment property, transfers from investment property. I'm just leaving 2 lines or what open if I forgot something. I don't think we need impairments because we don't have to do the vehicles. In case I forgot something, and it's going to end off with cost, accumulated depreciation, and carry value. Right, I'm going to start with building 01. So at the beginning of the year, building 01 was investment property, and it became PPE on the 1st of May 2014. So at the beginning of the year, it was investment property, so we have no balances for it as PPE. Then during the year, we receive a transfer from investment property at its net replacement value of 1,602,000. So here you can clearly see in investment property, there we have taken it out, and here we've received it into PPE. Then I remember we also measured some depreciation on it. If I go back to that journal entry. Building 01, it was entries required in the second part. It became a PPE, and then we measured some depreciation on it. So I'm just going to copy this total and put it in here. Depreciation. Let's try again. Equals minus this figure. Right, so this is the first depreciation that we have measured on this asset. So therefore, we will say the cost price is the fair value at transfer, and the accumulated depreciation is the depreciation for the bit of time that we've had it. And then we are able to calculate a carry value for it. I'm just rounding it to 2 decimals. There's some 3 odd cents. Seems a bit annoying, but you can't say that we don't apply precision. Right, with the other building that we've had some calculations already done, so I'm just going to skip building 2 and go to building 3. Because building 3 was PPE at the beginning of the year. And it had a cost of 217,000, and it had an accumulated depreciation of 27,125. And that gave us a carry value at the beginning of the year of 214,2875. So let's see, we have recognized for building 3, we had recognized some depreciation, and then we had to eliminate the depreciation, but still we have this entry here, and then we have some depreciation again somewhere. Is it not? Yeah. Nope. We have a revaluation surplus for it, so we're going to use this one. Oh yeah, here it is. Accumulated revaluation, take out accumulated, measure the revaluation surplus. So here we also have a revaluation surplus for it. So I'm just looking for my entries. Then I measured some depreciation on it. Then there was a revaluation surplus again, and then it became investment property. So for the depreciation, I'm going to say it's equal to this amount of depreciation that we've calculated here. So minus this amount. And then the revaluation surplus will be the sum of the two surpluses that was measured. So at the beginning of the year, we had to revalue it, and it had a revaluation surplus, which is that amount. Plus, we had another revaluation surplus before it was reclassified. And then I just want to we had to transfer it to investment property at its net replacement value at the date of 2.4 million. And then, of course, at year end, this was now investment property, so we had balances equal to 0. Let's look at building number 2 and building number 4. They didn't tell us any calculations that we had to do for it in terms of journaling, but let's see. At the beginning of the year, we had for building 2 a 2125,000 cost. We had an accumulated depreciation of 212500, and that we also had then a carry value. Oh, come on. Of 1912500. Then we had to revalue this asset at the beginning of the year. So we had to go and see what was the value of this asset at the beginning of the year. I believe this asset was revalued to 2.4 million. So there we have it, 2.4 million. So the revaluation surplus will be the difference between the carry value and the fair value. In other words, it is going to be the 2.4 million minus this carry value at the beginning of the year. So the revaluation surplus was 187,500. Right, so what we would have done is we would have eliminated the accumulated depreciation. So let's just look at the entries. So I'm going to say this is just for calculations. And we're going to have to do entries. Let's make this building 02. And we have debits and credits. So what we would have done is we would have taken out the accumulated depreciation at the beginning of the year. We would have played it off against building 02. And that was this total of 212,500. Then we would have recognized the revaluation surplus. So it would have been debit the building 02 and revaluation surplus should be increasing by this 487,500. All right, then at the end of the year, we should have recognized some depreciation. So we're going to say we debit depreciation, we credit accumulated depreciation on building 02. And now we need to go and see, but how many months are passed? So the total life is 25 years, so it's 25 times 12. What was the remaining years at the beginning? Well, we need to go remaining. We need to go and see what is the cost of this asset. It was 2125,000. So the depreciation for 1 year would have been that total divided by 25 years. And the accumulated depreciation at this time was 212,500. So in terms of years, we have written off 2.4 years, and in months that is going to be 2.5 times 12 is going to be 30 months. So the remaining will be 300 minus 30 months, which is 270 months. To get to the depreciation, we will take then the last fair value that was measured, because we've now revaluated it, and the last fair value was 2.4 million, I believe. So it's 2.4 million divided by the remaining 270 months. And we had the asset for a whole year, so it's times 12. And that gives us 106,666,667. So I'm just going to round it to 2 decimals. Right, so I need to go and fill that in. Thus, I've had a revaluation surplus. The accumulated depreciation I've eliminated. I've had some depreciation. I see that I've not typed this correctly. This should be depreciation, debit depreciation. 2.4 million divided by 270 months for 12 months. Right. And then, of course, at the end of the year, I am going to have a cost, which is the newest fair value for 2.4 million. And I'm going to have an accumulated depreciation that is equal to my depreciation. Because the other accumulated depreciation I have eliminated at the beginning of the year. So in that account, I only have 106,666,67, which leaves me with a carry value of 229,333,33. So that's 2,293,333. Great. We have one more building to do, building 4. At the beginning of the year, it was a 2.2 million rand cost. It had a accumulated depreciation of 550,000. In other words, the opening balance there for carry value was 1,650,000. All right, at the beginning of the year, we can go and measure a revaluation surplus, which would be the difference between 2.5 million at the beginning of the year minus the carry value. So this 2.5 million is given here for building 4. Right, then we need to go and sort out our journal entries so that we can know what the depreciation is. We already know that the cost price at the end of the year will be the newest revaluation fair value, which is 2.5 million. All right, so I'm going to do the same entries here for building 4. So this will be building 2, and this will be building 4. So the first thing we're going to do is also take out the accumulated depreciation. So consider this a debit and a credit again. So we're going to take out the accumulated depreciation of 550,000. We're going to recognize the revaluation surplus, but this will be against building 4, of course. So the revaluation surplus, we just calculated that to be 850,000. Right, then we need to go and figure out the depreciation. So the total life for this asset will also be 300 months. And then the remaining life at the beginning of the year will be, what is the cost price? 2.2 million. Then what is depreciation for a year? Well, if we divide that by 25, 1 year is 88,000. What is the accumulated depreciation at the beginning of the year? 550,000. How many years have we depreciated for? 550 divided by 88 is 6.25 years, and we times that by months. It's 75 months. So the remaining to be depreciated is 300 minus 75. That is 22225. In other words, this depreciation is now going to be, I'm just going to put slashes here, building 04, slash building 04, slash building 04. All right. So for building 04, the depreciation is going to be the previous fair value, 2.5 million, divided by the remaining life times the 12 months because we've had it for the whole year. So that's 133,333. It's going to round to 2 decimals. And then we can go and fill out the depreciation. It is going to be equal to minus this figure. Right, we have eliminated all the depreciation at the beginning of the year. And therefore, the only depreciation that is still in the account is this 133,333. So therefore, the carry value at year end is 236,6666,67. I'm going to use my sum of function and I'm just going to get the totals. And then we have completed this question successfully. All right, so that was Metro. Quite an interesting one, quite difficult and tricky, but I like it. I'd rather give you a difficult question now than only in the test. So this was a very nice question. Revaluations at the beginning and at the end of the year. Changes, impairment losses. I think it was a great question. If you have any questions, please contact me for consultation. Otherwise, I will see you in my next video.